This video is for education and news analysis only. It is not financial advice, and it is not a recommendation to buy or sell any asset. Crypto is volatile, ETF flows can reverse quickly, and every viewer should do their own research. Here is the ComRead on crypto for Saturday, May 16, 2026. The headline today is simple: Bitcoin and Ethereum are not trading in a vacuum. They are being pulled around by the same forces moving the broader risk market: Treasury yields, inflation expectations, oil prices, institutional flows, and the next round of crypto regulation. Bitcoin has been struggling around the high $70,000 area, with several market reports pointing to a move toward, or just under, 80,000. That does not automatically mean the cycle is broken. But it does mean the market is being asked a harder question: can Bitcoin keep attracting marginal demand when cash and treasuries are offering more competition? That question matters because rates are the gravity of financial markets. When treasury yields rise, investors can get a higher return from assets that are considered lower risk. That usually makes speculative or long-duration assets less attractive at the margin. Crypto often trades like a high-beta liquidity asset, so when yields rise quickly, Bitcoin and Ether can feel pressure even if nothing changed inside the networks themselves. The second major story is ETF flows. U.S. spot Bitcoin ETFs reportedly saw about $290 million of net outflows on May 15, and roughly $1 billion of net outflows for the week. That ended a 6-week inflow streak. This is important because ETF flows have become one of the cleanest public windows into institutional demand. A single outflow week should not be overinterpreted. Institutions rebalance. Traders take profits. Risk desks reduce exposure when macro gets messy. But the change in direction is still worth watching. When Bitcoin ETFs are taking in steady money, they can absorb supply and support sentiment. When the flow turns negative, the market loses one of its clearest tailwinds. Ethereum is facing a similar, and maybe sharper, issue. Reports showed U.S. spot Ethereum ETFs with about $65.6 million of net outflows on May 15, extending a multi-day losing streak. Ethereum has its own fundamentals: staking, Layer 2s, stablecoin activity, DeFi, and application revenue. But in the short term, ETF demand is part of the price story. If Ether funds continue to leak assets while Bitcoin funds are also under pressure, the market may demand stronger on-chain or macro evidence before paying a higher multiple. So the first lesson today is this: flows are not fundamentals by themselves, but they often tell us where the pressure is. ETF inflows can make a rally smoother. ETF outflows can make every resistance level feel heavier. The third story is regulation. The Senate Banking Committee advanced the Digital Asset Market Clarity Act, commonly called the Clarity Act, in a bipartisan vote. The bill still needs to move through the full legislative process, and the final version could change. but the direction matters. Markets have spent years pricing crypto with a giant question mark over who regulates what. Is a token a security? Is it a commodity? Which agency has primary jurisdiction? What disclosures are required? Which intermediaries can operate legally? Clearer rules do not remove risk. In some cases, regulation can be restrictive. It can raise compliance costs and push smaller players out. But for large institutions, clarity is often better than ambiguity. A pension fund, bank, ETF issuer, or registered advisor usually cannot build a major allocation strategy on vibes. They need defined rules, custody standards, reporting obligations, and legal boundaries. That is why regulatory progress can be bullish in the long run, even on a day when prices are weak. The market can sell off because yields are rising, while still gradually improving its institutional infrastructure. Both things can be true at the same time. The fourth story is security. THORChain reportedly paused trading after security researchers flagged a suspected multi-chain exploit of more than $10 million. Early reports suggested one protocol-controlled vault was compromised, and that automated defenses helped limit further damage. But the broader point is bigger than one protocol. Security incidents are not just technical events. They are confidence events. When a bridge, exchange, DeFi protocol, or cross-chain system gets hit, investors remember that smart contract risk, validator risk, key management risk, and operational risk are still part of crypto. Even if Bitcoin itself is not affected, the headline can weigh on sentiment across the sector. This is where crypto education needs to be honest. Price charts get attention, but risk management is what keeps people alive long enough to learn. If an asset requires a wallet, a bridge, a staking contract, or a centralized platform, each layer adds a different kind of risk. Now let us bring the pieces together. The bullish scenario is that ETF outflows stabilize quickly, yields cool off, and the Clarity Act keeps moving forward in a way that gives institutions more confidence. In that setup, Bitcoin could regain its institutional bid, Ethereum could recover if fund flows improve, and the market could treat this week as a macro-driven reset rather than a trend change. The neutral scenario is consolidation. Bitcoin chops around a range. Ethereum remains sensitive to ETF data. Traders wait for the next inflation print, the next Fed signal, and the next few days of ETF flows. In this scenario, the best signal is not one dramatic candle. It is whether buyers show up repeatedly when price tests support. The bearish scenario is that Treasury yields keep rising, ETF outflows continue, and security or regulatory shocks create another wave of de-risking. If that happens, the market may care less about long-term adoption stories and more about liquidity today. In crypto, when liquidity gets defensive, correlations often rise and even good assets can trade poorly. For viewers, the practical takeaway is not to guess the next tick. The practical takeaway is to watch the dashboard. Watch Bitcoin ETF net flows. Watch Ethereum ETF net flows. Watch the 10-year Treasury yield. Watch oil and inflation expectations. Watch whether regulatory clarity is becoming real law or just another headline. And watch security incidents, because trust is part of market structure. My read today is cautious, not panicked. The long-term institutional story for crypto is still alive, but the short-term market is being tested by macro pressure and flow reversals. That makes this a disciplined day. Separate news from noise, scenarios from certainty, and education from advice. That is the update for May 16th. If you track only 3 things after this video, track ETF flows, Treasury yields, and whether the Clarity Act keeps progressing without creating new uncertainty. Those 3 signals will probably explain more of the next move than most social media price calls. Again, this was educational commentary, not financial advice. Stay careful, stay skeptical, and do not let volatility do your thinking for you.